Welcome to this current affair topic where MSF marginal standing facility has been increased from 2% to 3% by the RBI. So what exactly this increase, what is MSF, and what are the other technical terms which related to the economics and the banking? So for this we will move ahead with this lecture. We will see what is the function of the RBI and what is RBI for the bank and how it works. So moving ahead with this lecture, first we have to understand what is NDTL. In the layman term, I will explain in this manner. Like suppose there will be a bank that will take deposit from a person. Like you have a bank account in an Axis Bank. Okay, so you deposit certain amount in your saving account, and further banks use your money to lend it in the market in the form of loan, and in return, as you are storing your money in the banks, so bank used to pay some interest on that amount. Further, that interest is low, but bank used to pay some interest on that saving accounts. Similarly, when bank lends your money in the market, banks also charge some interest. So based on these only, this NDTL is based, that net demands and time liabilities. So what is it? We will see. The bank will take deposit from a person in his SBI account, and fixed deposits is in the form of FD, RD and all. Okay, after some time bank will return you a principal plus interest. Principal will be your money that you have deposited plus some interest. If you are depositing FD, then there will be some 4%, 5%. Right now due to COVID, that it is for, if you are depositing for 6 months, then it is around 2%, but if you are depositing for 11 months, then you will get around 5% interest rate. So similar kind of interest rates are there. So when you deposit that amount in the bank, you will get interest also. It means that deposits which are collected by the banks are the liabilities on the bank. Why? Because bank have to pay some interest to you as you are depositing money into it. So bank have certain liabilities. So what the money you are depositing in the bank is the liability for the bank. Okay, it means bank owes to that person. Bank owes me that, as I have deposited that money to you, so this is your responsibility, and you owes to that money that you have to return interest to me. So whereas bank issues loans, now bank will issue loan in the market, and on that loan bank will collect some interest, and that loan that issued by the bank will be asset for the bank. Are you understanding how is it working? That you have rupees 100 you deposited in the bank. Okay, bank will return you rupees 110 as an interest after some period of time, x period of time. Okay, now bank will lend your money rupees 100 in the market, and bank will charge more interest from that market. Let's suppose bank will take rupees 130 in return by the borrower. So bank will return this rupees 130. In among that rupees 130, 110 will be given to you, and 20 rupees will be the profit of the bank. And in this way banks work. So the loans which are issued by the banks are assets for the bank. So net demand and time liabilities, it means there are certain liabilities which bank are demand, and the time liabilities will be there. So what exactly is demand liabilities and time liabilities? Still NDTL is not come. Now I will explain how NDTL terms will come here. So demand liabilities, those deposits which are kept with the bank, which can be withdrawn whenever demands will rise. The amount that I have deposited in the bank, that is my saving account, that FD and all everything, so I can withdraw from my saving accounts whenever I want. So that is what, that is demand liabilities. It is not like that bank will not say no, right now you can't withdraw money from ATM. It's not like that. You can withdraw money from your account whenever you want. So one is demand liabilities and another is time liabilities, like fixed deposit. You have done FD or RD with the bank for 1 month, for 6 months, for 8th month, for 11th month. It means that it is time bounded. So these are the deposits which are kept by the customer to the bank for a specific period of time. That will come under time liabilities. Demand liabilities, the money you are keeping with the bank in the saving accounts, like saving account where you can withdraw money whenever you want. And time liabilities will be that where you have deposited money in the bank by the customer for a specific period of time. That will be your time liabilities. Now what is NDTL exactly? We will see here. Now sum total of time deposits that you have done FD and demand deposits that you have given. So let us suppose your saving account balance. So saving account balance and your current account balance, that saving accounts balance and your FD, fixed deposit. Those total will give you gross demand time liabilities. That will give you GDTL. And now in this GDTL, interbank deposits will happen. Like if some bank needs money for a small period of time, like for 1 day, 24 hours, within a night also some banks required, like RBI had given guidelines, like for end of the day you must have rupees 100 crore in your account. RBI has ordered the bank. Let us suppose, I am giving just an example, let us suppose RBI has given order that every bank should be have rupees 100 crore in their bank balance by the end of the day, every day. Now let us suppose one bank it have 90 crores. Now the one bank is have short of rupees 10 crore. In that case, that bank B will ask another bank who have more than 100 crore. Like one bank, let us suppose, have 110 crore in his account. So this bank which have a 90 crore for today, he will go to this bank which has 110 and he will ask rupees 10 crore for one night. So this 10 crore will be given to that bank. So that amount, like if there, so it is, this duration is for this transaction happens within a night, this transaction is for 1 day. Let us suppose this transaction happened for 1 month, have given money to the another bank. So in that case, when you deduct that amount from this GDTL, that will give you NDTL. If another bank does not give, then NDTL, then GDTL is equal to NDTL for that scenario. Like suppose I am telling that if suppose your bank did not lend any money to the another bank, so in that case what will be your interbank deposit? That will be rupees 0. So now from GDTL, if you deduct rupees 0, it will what? It will give you NDTL. So NDTL in that case will be equal to your GDTL. So NDTL basically is that sum of total time deposits and demand deposits, and if that bank have any deposits with another bank, any interbank deposits kind of happen, deduct that amount, then it will give you a net demand time liabilities. Just understand one concept, that whenever you have a net term anywhere, it means there will be a subtraction. Here this is another scenario where a bank does not haven't lent any money to the another bank. In that case, rupees 0 will be your interbank deposit, and in that case GDTL will be equal to your NDTL. Okay, moving ahead, another term we have to understand, what is statutory liquid ratio. What is statutory liquid ratio? SLR. Now I will move ahead with this example, you will understand it. So it is the percentage of NDTL that I have explained it here. It is the percentage of NDTL that bank has to maintain with itself, either in the form of cash, G securities or gold. Now you understand what is cash. G securities means government issues some bond, like If government needs money, government issues bond and government takes money from the bank, and after some period of time government will return that money. Then you have to return the G securities and government will pay some interest on that. That is something called G security, that is bond. Then you have a cash and then you have a gold. So there is some percentage of NDTL that bank has to mention itself. Like we can't make any bank free of it. Like you can maintain any money, you can't maintain. So one bank is not maintaining any amount of money, that may lead to a situation bankrupt kind of situation. So for that there are some guidelines that used to give by RBI, that you have to maintain certain percentage of money with your bank. So that's why it is the percentage of SLR is the percentage of NDTL that bank has to maintain with itself, either in the form of cash, G securities or gold. Now why gold is not suggested, we will see. Apart from CRR, that cash reserve ratio is that bank has to maintain SLR. So there are some cash reserve ratio that bank has to maintain, another term that we have to maintain SLR also. So in this case, in SLR, the percentage of NDTL has to be maintained in the form of cash, G securities, gold. Example, let us assume bank has collected rupees 100 crore rupees in the form of NDTL. NDTL means what? You have FD of, let us suppose, rupees 50, and you have rupees 80 in the rupees 30 in the bank. So 50 plus 30 to 80, and let us suppose interbank that is happened. So let me clear it again. Let us suppose you have a FD of rupees 50 and you have a saving bank account of rupees 70, and further you have interbank that loan has been given. So for, let us suppose, 20. So in that case you have rupees 100 with you. So that will be NDTL. In that government will say that you have to maintain 20%. Then rupees 20 should be there in your account every time. So similar kind of example is given here. Let us assume bank has collected rupees 100 crore rupees in the form of NDTL and SLR is 20%. It means among 100 crores, 20 crores has to be maintained by the bank itself, either in the form of gold, G securities or cash. Although there are three options with the bank to maintain these 320 crores. Now, which thing bank will choose? Cash, G securities or gold? There is a problem with gold, and government also does not suggest any customer, the people of India, to buy gold, because there is a loss in gold, as the price of gold is very volatile in the market. We don't know what will happen that price, and further, if you buy gold, it will be act as a storage. That money flow in the market will stop. If you are investing money in the market, it means what? Your money will flow in the market, so your economy will be stronger, it will be always working. And if you are buying gold, it will be stored in your cupboard and it will be given to your next generation, to the next generation. Ultimately that money lost from the market, because you have buy gold and it has been stored in your cupboard. Now that money will not flow in the market. That's why it is suggested that gold should not be part of any economy for storing. And so that's why government is in COVID situation also, government is not enforcing in Diwali, Dhanteras and all to buy gold. They are asking for invest anything or any other flow of money you can give in the market, but not gold. Further, banks also not trust on the gold because their price is very volatile. So bank can choose to invest in G securities. Why this? Why is there so? Not in cash also. So in this section, bank is allowed to give loan in the market for only 80 crores, because in this example, in the above example, that rupees 100 crores was with the bank NDTL and rupees 20% has to be maintained in the form of SLR. So now bank can lend only 80 crores in the market, but the problem is that bank can lend only 80 crores, but it has to pay interest on the full 100 crores. Yeah, just understand one more thing here, that bank has rupees 100 crore. Now government has said, or RBI has said, that you have to maintain 20% of the NDTL. right? Now it means 80 crores can bank lend in the market. Now one thing sure, now 20 crores will be left with the bank in their saving accounts. The person who have deposited this 100 crore in the bank has to pay interest on the whole 100 crore rupees, but the government is saying that you have to keep 20 crore as a safe deposit. So how this government bank will pay interest on this 20 crore, as bank can lend rupees 80 crore only in the market. In that case, the interest will be managed that much that 20 crore will also be covered and 80 crore will also be covered, and overall the interest on the 100 crore will be paid to the customer. Okay, so that thing is explained here. So that's why bank has to lend 80 crore in the market. So the 80 crore, but the problem is that 80 crore, but it has to pay interest on the full 100 crore. So if they keep 20 crore in the cash, they will not earn anything. So the price of gold is very volatile in the market. So investing in the gold is very dangerous as they are volatile, as I've explained. So the only option left with them is to invest G securities, bond issued by the government. That I've explained what is G securities. Bond issued by the government and auctioned by the RBI. And whenever RBI auctioned it, the money will be given to the government of India. It is like bond will issued by the government, and the auction will be done by the selling of that bond and all will be done by the RBI, and whatever the money will be collected, it will be given to the government of India. Okay, so whatever the money is raised by the government of India will automatically become the part of fiscal policy. So it is saying that thus only option is left with the investment in the G securities, as they will get certain interest rate returns through it by the government. So the coupon rate or the rate of interest on G securities will almost be similar to the repo rate. Repo rate is around 4%, is like that. Repo rate, what do you understand by repo rate? When a bank takes money from RBI, let us suppose bank needs money for one day, so banks will take money from RBI. So RBI lend money to the bank. In that case, there will be a fixed rate. That rate of interest will be called as your repo rate. And there are some scenarios where RBI will take money from the bank. RBI may need money from the bank. In that case, there will be interest rate, and that interest will be called your as inverse repo rate, reverse repo rate. Okay, so that is something that G securities will be sold in that way. So SLR is more fiscal policy repository tools rather than monetary policy tools. That is what it is said, that this fiscal policy, it is the policy decided by the government of India, not the policy decided by the RBI. This SLR is decided by the government of India mainly. Okay, now there is one example that is given. Let us suppose SLR is 20%. Bank started to invest more than 26% in the G securities. Then SLR, it may be that bank realized that current investing in the market is scarce, thus move to the purchasing more and more G securities. That statement I have given, just want to tell you that it is not like bank can not take G securities more than 20%. That SLR was given 20%. It is not like that bank can't give money to that can't take money more than 20%. Yes, bank can also take more than 20% to 26%, 30% also. Why? If banks feel the market is very volatile right now, I can't invest in the market, bank may take, if they are feeling safe with buying G securities, they will buy G securities. Okay, so whenever SLR is reduced, one more thing you have to understand. Let us suppose now, as I've explained in the example, that 100 crore was with the bank, 20% was the SLR. So 20 crore will have to be with the bank, and they have to maintain as a safe deposit. So bank will buy government bonds and all for that 20 crore rupees. Now let us suppose government have reduced this SLR to 10%. So now 10 crore will be with the bank. So can you expect bank have to increase interest rate for you that you have deposited in the bank, rupees 100 crore in the bank. So earlier when there was 20% SLR, you were getting 4% interest rate. Now the government has said no, we have reduced SLR, now you can deposit, now you can maintain 10% only. So in that case, what, now the bank will have 90 crores with them in the market to lend, and it will lend in the higher rate of interest. So in that case, can you expect bank have to increase the interest rate for you? No, it is up to the bank. Bank either give you only 4% only, and bank will sell this 90% in the market with the same interest rate, with the greater interest rate, and bank will earning more profit in that scenario if the bank is not increasing the interest rate for you. So it means that whenever SLR is reduced, it is not like that bank have to lend, it is up to the bank that they have to reduce or not. So in that case, there have been some steps have been also taken, like RBI has reduced repo rate, and also RBI has said many of the banks have not reduced the interest rate. As RBI has reduced the interest rate, that repo rate, so banks should also reduce the interest rate to the public, that whenever the public is taking loan from the bank. But most of the banks are not doing it. So there are certain meetings have been held, we will see in the coming session. So it is that with this topic only you have to take care that it is not up to the bank, it is not liable on the bank that if the SLR is reduced, bank have to increase the interest. No, bank can interest, bank may not interest, bank will earn more profit. So whenever SLR is reduced, can we expect bank should also reduce the lending rate? No, it is because bank is not getting extra even after the reduction of SLR. So support SLR reduced to 20%, 90%, the bank have invest 26% in the G security. It does not mean 19% will lend some extra to the bank. So this statement is more clearing one fact that if the SLR reduce the 10%, the money is the same one. Like if some other is wanting, otherwise bank has to give loan in the market to earn it. Like suppose bank will increase your interest rate and nobody has borrowed or nobody has taken loan from the bank. In that case, what, from where the bank will pay you? So that's why it is not expected that lending rate will increase for you, that or interest rate for money depositing in the bank will increase. It is not like that. So moving ahead, what are the functions of RBI? So what is RBI? RBI is known as the banker of last resort. Why? We will see. So bankers to banker, regulator of banking system, that is RBI. So let us assume a new entity wants to set up a bank in India. So all the processes, whatever the licenses required, guidelines, regulations and all, these things will be taken care by the RBI. And hence RBI is called as a regulator of banking system, or it is called as a banker of last resort. So whatever the policies are required, what are the processes required, there should be some authority. So that authority is our RBI. Okay. So now we have to understand what is marginal standing facility. This is with respect to our current affair where it has been increased from 2% to 3%. Yeah, where it has been increased to 2% to 3%, and it is up to 31st March 2021. So what is this marginal standing facility? Just pay attention here, it is very important. Further, I will request you to please go through this lecture till the end for understanding every topic, because if you skip anything, it will be very difficult to catch all those topics. Okay, so let us assume there is a bank. So it can borrow from RBI either for short term, it can borrow money from RBI either for short term or long term under the concept of repo rate. As I explained, if you are taking money from the RBI will give money to you, and the interest that RBI will take from you, that will be called as a repo rate. And the another scenario is the opposite scenario. If the RBI is taking money from the bank, so the interest rate that bank will charge to the RBI will be called as a reverse repo rate, and these both things will be being decided by the RBI. So long term under the concept of repo rate and SLR. So apart from this, bank has to abide by the liquidity adjustment. That bank has to maintain some liquidity with them. So RBI has put some certain guidelines regarding the money to be in the banking sector. To meet such guidelines, that liquidity adjustment to put on the RBI, the bank use certain situations which is it will borrow from the various sources under the concept called liquidity adjustment facilities. That there are certain percentage that used to be decided by RBI to maintain some liquidity assets with the bank, and in that scenario bank will borrow money from various sources, and that will come under a concept of liquidity adjustment facilities. And one of the LAF tool is repo rate, that if you are shorting of the money you can take loan from the RBI, so that will one is repo rate, and another is marginal standing facility, MSF. Now what is MSF? Repo rate, you understand that these are, see, liquid adjustment facility is a concept under which you have a two tools that will be your, that this tool contains have a two things that will have a repo rate and marginal standing facility. So marginal standing facility we will understand with this example. Let us consider a situation where RBI has put a guidelines that by the end of the day bank has to maintain rupees 100 crores. Previous one example, okay. Now imagine the bank had only rupees 99 crore with them. So the bank is a shortfall of how much? Rupees 1 crore. In this case bank will borrow 1 crore under repo rate. Like if the bank is getting short of rupees 1 crore, bank will ask money from the RBI and they will say we will return it after 24 hours. So in that scenario repo rate will be applied because it is taking money, it is borrowing money from the RBI. So under repo rate, so because under repo rate banks borrow money from the RBI to lending purposes, not to meet liquidity crunch situations. See, one thing I missed here. So under repo rate bank borrows money from RBI for lending purposes. Like if bank wants to give money in the market and all, RBI does not give money in the liquid crunch situation, like when the liquid adjustment facilities kind of situation. In that scenario, if you have a liquidity issues, liquid adjustment possibility, like if you are not lending that money in the market, then in that scenario RBI may not give. Okay, so in this case, to meet the liquidity crisis, bank will approach RBI under the concept of MSF. Like bank will give, I will explain it, I will clear one thing here, that bank will give repo rate. On the concept of repo rate, bank will lend money, will give money to the bank only in the scenario if bank wants to lend money in the market. This money rupees 1 crore that the bank is for, it is not because of that bank wants to lend that 1 crore in the market. It is for just, it has to fulfill its minimum requirement liquidity adjustment for the day. So in that scenario bank will go approach RBI under the concept of MSF. Now RBI will lend rupees 1 crore, but there will be two conditions. The conditions will be such. Now the RBI will lend rupees 1 crore, but it is not under the concept of repo rate, it will consider under MSF. The conditions will be such that RBI will give loan for very short duration, that like for overnight purposes and only up to the value of 2% of the NDTL. I have explained NDTL, your FD plus saving accounts, and if a interbank lending happens then you have to deduct it, and then whatever the money you will have, then that will become under NDTL. So the 2% of the NDTL up to bank will, RBI will lend you. And let us suppose bank has NDTL rupees 100 crore, so maximum bank can borrow for overnight purpose is the rupees 2 crore. Understand? Now second case, second scenario that is to follow, whatever the rate of interest will be imposed will be higher than the repo rate. See, repo rate actually RBI decides, like if the bank is shortfall of money and it has to revive and all, in that scenario RBI gives money, take that money, I will charge less interest, lend that money in the market, earn the interest, then return me with the RR, with the repo rate that we have decided. Okay, but if you have a shortfall of money for liquidity adjustment, in that scenario you have to take money in the concept of MSF, where you can take money up to 2% of your NDTL. Whatever you have NDTL, up to 2% you can take it. Second case, the repo rate that whatever the interest rate will be charged will be greater than your repo rate. If the interest rate is similar to the repo rate, equal to the repo rate, then what is the difference between MSF and RR? No, difference is that in MSF, whatever the interest will be charged will be imposed higher than the repo rate, and that higher repo rate will be decided by whom? That will be decided by RBI only. So such as repo rate is, let us suppose 6% is the repo rate. So now the RBI will say we will charge plus 25 BPS, that is base price. So up to that 25 BPS, so the total price that will be, you have to pay interest, that will be 6.25%. Just I have given for the information that 100 BPS is equal to 1%. So rate of interest will be your 6.25% for this MSF, for the maintaining of your liquidity adjustment facility. Understand? This is all about that how this liquidity adjustment facility under this work, marginal standing facility, works, and that is the difference between marginal standing facility and the repo rate. Now moving ahead, second functions of the RBI, that it manages foreign reserves, forex reserves and all, dollars, currencies and all. So RBI is the manager of forex reserves. What are the forex reserves? That is euros, dollars, dinar and all, everything whatever with the RBI, whatever the foreign currencies with the have the India, that is RBI is maintaining it. So it means it maintains the forex reserves, and forex exchange reserves contains of three important components. First, it will consist of a basket of foreign currencies, like whatever different types of euros, dollars and all. Another, it will consist of gold reserves. Gold reserves is also one of the crucial part that is stored for in case of emergency loan by the another country or world banks and all. This can be used in the emergency kind of situation. So gold reserves is also maintained by the RBI. And third, it will consist of SDR, a special drawing rights. Understand this term, it is very important. Focus it here. What is SDR? It consists of a special drawing rights. So SDR are the currencies issued by the International Monetary Fund. So how is it like? It is just from another currency. So like when India became the member of IMF, India will make certain contribution to become the member of IMF. In return, India will give two important power. India takes one voting rights will be given to India, was given, and the certain the currencies which are called SDR will be given to India. So the value of SDR will be calculated by IMF on day-to-day basis, and the value of SDR is dependent on the basket of currencies, dollar and euro. So it is like that. In the market, you can go on the Google and you can search like what is the dollar price right now. It is maybe rupees 70. So $1 is equal to rupees 70 right now. In that case, we have another SDR currency that is being updated by the IMF, International Monetary Fund. Okay, and now based on this particular value, if India needs dollar, India will simply sell this SDR, not their rupees in the market. Like rupees price is very high, like rupees 70 equal to $1. So in that case, India may give too much money in the market, and India may shortfall of rupees currency in their domestic market, and ultimately what will happen? Inflation will come. So that's why India will use the SDR currencies, and SDR currencies value is monitored by the IMF on the day-to-day basis. It is similarly like updated as per the market and all. Okay, so now based on the particular value, India, like suppose today India have a shortage of dollars, so India will buy dollars. So what will they exchange? Not Indian currency, they will exchange SDR. And this is the important concept called SDR, that in on the place of that Indian currency rupees, you will send buy this in the form of SDR by selling the SDR currency. So this is the important, like this will help in not shortfall of Indian currency in the market. So earlier each country used to calculate their forex reserves and used to keep it as a secret what is their forex reserves and all. But because of the guidelines of this IMF, now every country calculate their value of forex reserves in the terms of dollars and publish it. In case of India, RBI manages the forex reserves. So it is saying that what, like forex reserves, all the countries used to hide there, like what kind of dollar we have stored in our reserves and all. So countries used to hide that so that the other countries, the rational countries, like some countries like which are against, like China, may know that, oh, now India is facing shortage of dollar, so now we can hit their economy right now. So that will give a chance to another country to hit on us. So that's why countries used to hide their forex reserves. But now the country which comes under the IMF, there is a guideline that you have to calculate whatever the currencies you have. We don't care, euro or whatever the other currencies, rupees and all you have to calculate in the form of dollar only. Okay, and thus we will be able to calculate it. So whatever you have, other currencies, pound also, euro also, Japanese yen also, Canadian dollar, Australian dollar, Swiss franc, so whatever you have, just calculate it in the form of dollar, and then you have to make it in public. So moving ahead, the last one, the function of the clearing house functions. Have you observed anything in the case of check, that a person has issued a check A, and that A check belongs to SBI. That person who issued you the check have an account in SBI, and the check that is issued is from the SBI. Now he has given money to the person B, but person B does not have an account in the SBI. He have an account in Axis. So how this Axis Bank will take money from this RBI? It is the money that is transferring from A account to B account, and both the banks are different. So how this Axis money will take money from A's account from the SBI? In that case, clearing house functions come. Thus your check will work. So how this works, we will see. So every bank, like scheduled commercial bank, will have its accounts with the RBI, like Axis Bank, Punjab National Bank, all have its account. Now Punjab National Bank will come under the SBI, and also let's say SBI and Axis Bank or ICICI. So these all banks have an account in what? These all banks have a account, A bank, B bank, C bank. These all have an account in RBI. And using these particular accounts, all the transaction will be done between each other. So this is a common point of scenario. Now the transaction, what will happen? This is a common point. Like if A want money from B, the check is from B bank, and A is the another person. So they will take money from B, will give money to the RBI, and A will take money from the RBI. That is the simple, in the layman term, this is the simple case how it works. Now using these particular accounts, all the transactions will be done to each other. So let us consider person X has provided certain services and issued a check of SBI. What will happen? This person does not have a bank in SBI, the another person. So this particular check will be called as a cross check, and this cross check is happening now. A is SBI and B is Axis Bank, so that's why it's called cross check. So it means he cannot go to SBI bank branch to withdraw the money because he don't have an account in the SBI. So as the money has to be cross checked with SBI to his account, but he does not have an SBI account, then he will go to his bank, Axis Bank, and submit the check there. Now Axis Bank will receive the money from SBI through where? Through the intermediate. And who is the intermediate? This is none other than your RBI. So this particular functions of clearing the check across the bank is known as clearing house functions, and RBI through their centers will perform the functions to clearing the houses, and wherever RBI centers are not present, SBI will perform the clearing of house functions. Like it is saying that if any RBI center is not present any place, in that case SBI will act as an RBI because it is also for the government, and in that case SBI will act as an intermediary. SBI will act as a common term, like a person A has a bank, has a check of Axis Bank, and person B has a bank of the person B is from the ICICI, so A has issued check, so A will take money from the A will give money to the SBI, and SBI will give money to the B. Okay, this is the scene how it works. This is something called clearing house functions. Now we have to understand what is Basel. Basel guidelines, like many times you used to heard Basel 1 guidelines, Basel 2 guidelines. Right now we are working on we are going to implement Basel 3 guidelines. So what is Basel? So Basel is a place in Switzerland, and Bank of International Settlement is there, and BCBS, Basel Committee on Banking Supervision. So Basel housed into two important institutions, and India is also a member of this BCBS, that Basel Committee on Banking Supervision. So the most important role is that they play by BCBS every now and then, and these, like all the countries members, like from the India it will be the RBI governor. Similarly for the other country there have banking officials and all. So in case of India we have a governors, and also for the central bank across the world they will come together and deliberate and come out and set up guidelines for the reference of the banking sector only. So in that way they will set up some guidelines, and it will be implemented in their own respective countries, okay, with their bank. So these guidelines will be predominantly to restore the financial health of the banking sector, so that the health of the banking sector will be good, will be efficient one. So in that guidelines we have issued till the 3. So Basel 1 implemented, Basel 2 has been given, Basel 3 guidelines. Now India, we are in the process of implementing Basel 3 guidelines from long back, and we have worked on very of the like lots of the guidelines of the Basel 3 on all, okay. So now I have explained all these terms, this NDTL, this statutory liquidity ratio, then functions of the RBI, that regulation banking system, managing forex risk, clearing house functions, and Basel. So why I have explained? Because of the current affair. These all are related to each other, because in the current affair there is a term that is related to the MSF, and for that MSF, that minimum standing facilities, that I have explained it here, that wait one second, I have explained that here marginal standing facility, that is MSF marginal standing facility. That for that marginal standing facility, again I have to go for the liquidity adjustment facility, and this liquidity adjustment facility will come under regulatory of bank system. So that's why I have explained all these topics, and this way this context of current affair came, how is related to this. So I have explained there that bank has to maintain 2% of the NDTL that is given by the RBI and all. So now it has been increased due to COVID situation to 3%, up to when? Till 31st March 2021. That now that banks were supposed to borrow, like they can borrow up to more than 3%. Till now, to maintain their liquidity assets, they were allowed to borrow only 2% with the RBI. Now they can borrow up to 3%, and whatever the rate of interest, as I've said, rate of interest will be greater than repo rate plus some interest, whatever the rate is, and this interest will be decided by the RBI only. So in this slide further, whenever the bank borrows under MSF, they will have to use G securities or the bond. So in return, like if the bank is borrowing some, they have to provide some asset as a security, so bank will provide G securities. So they are using as a collateral to RBI, and then generally RBI provides these kind of MSF when interbank lending and borrowing is taking place. So under this MSF, it was earlier, as I explained, it is up to 2%. Now it has been extended to 3% till March 2021. And liquidity coverage ratio, so this comes under the parts of the Basel guidelines, that bank are supposed to estimate that much of cash withdrawal in the next 30 days, that they are supposed to estimate that these, like that amount of liquid cash should be withdrawn in the next 30 days, and to ensure they will have a sufficient money with them also, so that they maintain amount of liquid asset with them. So by enhancing MSF to 2% to 3%, because MSF is what? MSF is relating to the liquidity asset maintenance only. So the bank have an option now to borrow from the RBI, which is nothing but a part of high quality liquid asset, where earlier it was allowed up to 2% of the NDTL, now it is 3% to the NDTL, and the rate of interest will be decided by the RBI, and it will be greater than repo rate. Okay, I hope you have understand this lecture. Please like and subscribe. Your subscription is a form of payment for me. It is a new channel. I hope you have liked the video. If you have any doubt, if you want any suggestions to give me, please feel free to ping on my Twitter handle. It is given in the description. Thank you.